Okay, everyone, welcome to today's live streamed webinar going over the markets currently. Going to touch on some really interesting points for what we're seeing in the markets right now. So what we're going to do, we're going to go through the commodity markets, we're going to go through the stock markets, the currency markets, and everything that's really driving the markets at this moment in time. We're going to fundamentally look at what is going on to understand what could happen moving forward, and basically just share some trade ideas with you guys if you are actively trading at the moment. So something that's really important for us to understand is China has reopened their economy from lockdowns, and this has a big impact, especially on commodities and currencies that are exporting commodities like Australia. They have a big impact. Okay, so China has ended its lockdown, okay, and now they're reopening the economy. Why? China's zero policy for COVID has really failed. Why they're not using the Western medicine that have allowed all the other countries to come out of lockdown, who really knows? But what's happening is China is reopening. So this is key to understand why China is so important, because if you look at China's economy here, we can look at what is China buying from the rest of the world. And if you look, China is a key commodity importer. They're importing commodities, especially crude oil and iron ore, okay, as well as they're importing other key commodities, okay? And what we need to do is just, first of all, assess who will benefit from China reopening and their economy being fully out of lockdowns, because the demand for goods and services, especially commodities, is going to pick up rapidly, and it's already happening. All right. So if we look, China, this is in 2018, so you can get a perspective of how big China is and how important it is to the global markets. China surpassed the United States as the world's largest crude oil importer in 2017. Okay, so China is a big reason for where oil prices go. All right. And here's a headline today on Bloomberg: oil extends gains as China's optimism outweighs a slowdown concerns. Okay, so we know higher interest rates in the United States is going to slow down growth in the United States, but because China is reopening their economy, this is absolutely key. All right, so if I show you this, you can get a good perspective on how important this reopening is. If I take you over here and I show you crude oil prices, so here we can look at US manufacturing PMI data and the price of crude oil. Now remember, US drives global growth. If the US is growing, the whole world is growing. If the US is really slowing, it can cause the rest of the world to slow. So the manufacturing data is very key because it predicts where the US economy is going. Okay, and you can see, you can have crude oil prices in red and the manufacturing data in the United States is in green. Okay, when you get a reading below 50 on the left hand side of the axis, this is the manufacturing data. On the right hand axis is the price of oil. So look, historically, when the US is going through a slowdown and the PMIs are contracting, it basically indicates the US is going through a recession. And look what happens: oil prices tumble. Okay, when the US goes back through economic growth, what happens? Oil prices rise again. You can look at this correlation from June 2006 until 2023. Okay, so we're looking at what, nearly 20 years of data here, and you can see there's a big correlation between US growth and crude oil prices. All right, so when this headline says optimism of China outweighs slowdown concerns, they're talking about the slowdown in the US economy. All right, and this is why crude oil prices are pushing ahead in the commodities markets. You see how we've had a rally higher in oil prices? This is because China has reopened their economy. Now, I was reading today, Goldman Sachs are predicting that crude oil prices will go up 15% to $100 a barrel. All right, because China is reopening. So if we can just understand how important China is, it's key. And then we can understand that because US inflation is on its way down, as I'll show you here. So if we're looking at the United States, we can see inflation's gone from 9.1%, way above the central bank's 2% target. But look, it's fallen for 6 months in a row, down to 7%. Core inflation, which strips out food and energy, and what the markets are closely looking at to know, is the Federal Reserve interest rate hikes working? Look what's happening. It's on its way down. 1, 2, 3 months. And in the first reading for 2023, 4 months in a row, core inflation is slowing. Okay. So what that is doing, that is driving up the market's bets that the Federal Reserve is going to cut interest rates. They're not sure when, but they're saying if prices are falling, then the Federal Reserve doesn't have to be so aggressive with interest rates, okay? And markets are betting maybe a rate cut in September or maybe December. They're not quite sure, but they're pricing in a rate cut. If they cut interest rates, what's going to happen? US growth will pick up again. Why? Interest rates are less expensive, are coming down. So interest payments on mortgages, credit cards, car loans, student debt, for example, all these debt payments go down. People have more disposable income. It drives spending. So what would happen? What would happen would be that data I was just showing you over here for the manufacturing data, that would start turning more positive. And if the US manufacturing starts to rise again, you know what's going to happen with crude oil. So I've just shown you the correlation for over 20 years. Okay, so this is what the markets are paying attention to. What is happening with the manufacturing data in the United States? Currently, it's gone down to 48, okay, from a reading in 2022 of being around 14.9. Okay, so it's gone down in the latest report. But if that starts to pick up again, goes back towards 50, then you know the growth expectations in the United States are coming back. That's good for oil. So we have China reopening, and analysts are expecting oil to go to $100 a barrel. If the US manufacturing starts to pick up as well, as inflation keeps slowing, then you know that US growth will continue to will recover from the slowdown. So you'd have a situation here where China's reopening is positive and the US economy are recovering, good for oil, okay? So we can look to buy crude oil. All right, if you're looking at buying crude oil, what you have to understand is what is the volatility of crude oil. So volatility is basically looking at how much does it fluctuate on a monthly basis. If you're using a 1 month volatility, I don't know what period you guys trade over, but I always put a stop loss, which is 1 month volatility. And basically it's a percentage, the average percentage swings in price for crude oil. And currently the average volatility is around 17%. So if you're going to jump into a trade, your stop loss is going to need to be around 17%. You can have a tight one of maybe 10%, for an example, on this trade. If you're using a weekly volatility, it's going to be lower. So your volatility will be around 9%, around here. Okay. I'm looking at potentially taking a buy position in crude oil based on China's demand, rate cuts in the United States, and oil prices pushing up. This is what all the analysts are saying. I'm reading it every single day. Okay. So this is our picture for crude oil. This is the potential trade you can take in the markets. All right. Now, on top of that, we have an important situation happening with copper prices. This is another commodity I'm looking at buying because copper is rallying very strongly at the moment and going up after a big decline in price. Why is copper going up? Yet again, where is copper being bought from? Okay, and what is it used for? So as you know, governments are now trying to move away from fossil fuels and move into clean energy. Copper is going to be the key commodity to this energy transition. All right. So look, you can see here, copper, the metal of electrification, is essential to all energy transition plans. This is why when I've been reading all the analysts talking about copper prices are going to go up for the next 10 years. Why? Because all these countries around the world are investing heavily in renewable energy that will push up the price of copper. So if we can get into a buy position of copper now, we'll be in a sweet trade for a very, very long time. So again, I'm looking to see if it can break firmly above this little period here of consolidation. And if you get above that consolidation, perfect. We can jump in the trade. Volatility on copper is around 11%. So we're going to have 11% stop loss on the position to make sure we don't get stopped out of a trade if it just has monthly fluctuations. Okay. And look, you can see how much the fluctuations recently, look, around 11%. Okay, so this volatility does really work. All right. Again, look, around 11% up there as well. So you can see that. So this is another trade that I'm looking at taking in the commodities markets for copper prices. All right, guys. So that's two key commodities we can look at. And why is copper very important to the world? As I said, the energy transition, but look carefully. If you go onto the OEC website, who buys a lot of copper? China. So China's reopening will drive growth in the Asian region as well, because they rely on trade with China. And that's why copper prices are also going up. China's reopening. Okay, so China, the second biggest economy in the world, is going to be doing a big transition into clean energy. Copper is going to be in demand. So that's a really good point to remember. China reopening doesn't just affect oil prices, it affects copper prices. And if I go back to that same spreadsheet and I show you historically, look, if you scroll down and we look at copper prices and manufacturing in the US, look, it tracks the manufacturing very closely, just like crude oil. And if I put crude oil on top of copper prices, look, they literally move at the same time. So if we look at the US inflation, we look at the US PMIs, we see what's going on in the United States. And if the US starts to recover and copper's going up as oil prices going up, we can take trades on both commodities, okay? So that's a really good trade I'm personally looking at taking in the markets, all right? So why else are we seeing the S&P 500 going higher? Look, it's now broken nearly above this downtrend. Look, for 1, 2, 3, 4 retests in this down channel. We're now getting another retest. Why? Yesterday, economic data came out for the United States and basically showed that the US is very resilient to the slowdown that markets are expecting from these interest rate hikes by the US central bank. So remember, the Fed has raised interest rates aggressively, and interest rates can cause a recession if you raise them too hard, okay? And the Fed is trying to raise them hard because they're trying to get inflation back down to 2%. And we can look at the speed at which the Fed's raising rates, the fastest speed since the 1980s. Look, back in March 2022, rates were at 0.25%. Within like 10 months, they're at 4.5%. There's raising rates at 75 basis points. That's 0.75%. That's not normal. They usually only raise rates at a 0.25%, but they're so far behind inflation, the Fed has to do something. They got to get inflation down quickly. Otherwise, it could become entrenched in the economy. And when I say entrenched, what that means is if inflation stays high for so long, consumers start to go to their bosses and say, look, I need a pay rise because I can't afford to live, right? Or they're threatened to leave and go work for someone else. So businesses don't want to lose their best workers. What are they going to do? They're going to raise prices on the shop floor on their goods and services because they want to retain their workers, but they need to raise prices because their wage bill is going up. So that's sustainable inflation, okay? And that's what's happening in the United States. So the Fed is trying to raise interest rates so aggressively that people cut back spending, reducing the demand for goods and services. Businesses start to let go of workers. There's now more people looking for work. Businesses, when they're trying to attract people into their company, they don't have to compete with other companies as much because there's more people available, and then they can start to lower wages. And if they can lower wages, then they can reduce prices. This is why the Federal Reserve is saying to the markets, we need to see wages go down as the unemployment rate goes up. And that should bring down core inflation. And it's working. Core inflation is on its way down. As I said, 3 months in a row for 2022. And then coming into 2023, again, 4 months in a row now, okay? So if we get today, we have PCE inflation. This is what the Federal Reserve says they like to look at the most. And it's coming out today. So the market's going to really pay attention to see, does PCE inflation, which is another reading for CPI inflation, just used in a different, the way they calculate is a bit different. But if it shows it's coming down again, perfect. That's good news for the US. Inflation's coming down. The US remains resilient. It's not contracting as fast as people were anticipating. And what does that do? It means that maybe the Fed can cut interest rates at the end of the year to save the economy from going into recession, because maybe they don't need to cause a recession because inflation's on its way down. Okay. And yesterday, when we had US data coming out, GDP, okay, the economy was expected to go from 3.2 to 2.6. It didn't. It came out at 2.9. That's why the stock markets rallied higher, because they're saying, oh shit, look, the US economy is stronger than we expected. And jobs in the United States are not getting lost at that much of a faster pace. Okay, so look, you can see here, the unemployment rate in the United States was at 3.7. And instead of it going up as people lose their jobs because of higher interest rates, it didn't. It actually went down to 3.5. So the markets are saying, shit, maybe the US economy is so strong that the unemployment rate is going to remain low. So people keep their jobs, but inflation's falling and wages are falling at the same time. So maybe the Fed can avoid a recession, cut interest rates if inflation comes down, and that will be good for US equities, okay? And remember, if interest rates go down, what happens to company earnings? It increases. So I'm going to show you something really important for you guys to understand. This is something called, let me just go here. I need to show you these two charts. This will really blow your mind about understanding stock markets. So we've got the PE ratio here. Let me take you guys down here. Okay, perfect. Yeah. All right, let me show you this. This is a key thing to understand. The cost at which companies borrow money, right? This is called the real yield. So basically you take the interest rate on a government bond and you subtract the expectations of inflation. Okay. So basically if the expectations for inflation are coming down, that basically can say to the markets, okay, maybe US companies can borrow money at a cheaper rate. And if that does happen, then that's obviously positive for the stock markets. Give us 1 second. I don't know why the chart's just gone like that. 1 sec, guys. Okay, so look what's happening right now. Because inflation is on its way down, right? The interest rate in the United States adjusted for inflation is going down, which basically means it's cheaper for companies to borrow money. But the earnings expectations of companies is valued based on the real yield. And basically what you're seeing is the PE ratio, which basically explains what is the price that you're willing to pay for the earnings of a company. And that price you're willing to pay is based on this real interest rate. So what we're seeing is the real yield is coming down, right? The PE ratio has kind of stabilized and it's happening at exactly the same time. So look, if I take away this PE ratio for you, if I take this away, I'll show you exactly what I mean. This is important for you guys to understand. So look what's happening in the United States. Look at the real yield on the right-hand side. Can you see that as that real yield is going down, look on the left-hand chart, look at stocks going up at exactly the same time. Okay, because it basically means that as the real yield goes down, the earnings are more valuable to investors. So as this keeps going down, because inflation keeps going down, and if markets keep pricing in interest rate hikes, that pushes up the stock market, because the earnings of stock markets, the value of those earnings are based on the interest rates adjusted for inflation. And at the moment, it's going down. That's why stocks are going up. You see, when it was going up previously, can you see over here? You can see this rally in the price here. Look what happened to the stocks on the left-hand side. It was going down. Can you see this period here where it was going down? So it's literally an inverse correlation. So all we got to do is say what's happening with inflation, what's happening with the real interest rate, because that it has an effect on how investors value the earnings of companies. It's called the discounted cash flow. You can go study it if you want. All right, guys, this is something I teach on my course, but it's really important. If you don't understand this, it's basically impossible to trade stocks because you don't really know and understand why investors are buying or selling stocks. It's all about the earnings expectations adjusted for interest rates when you calculate it with inflation, and that pushes up the earnings value to investors, okay? So look, US stocks are pushing higher. This is good. So the more inflation comes down, the more investors price in rate cuts, the more stock markets keep pushing to the upside. Okay, so this is really, really good for the stock market. So obviously I'm in a buy position for the stock market, been in it for a while. We got in like lower price. So we're nice. We're on our way up. And hopefully inflation keeps falling. So that's why today's data will be so key. What happens today? Does that PCE inflation come down lower? If it does, you already know how the market's going to react. They're going to go good, green light, buy stocks, buy equities because of that real interest rate. All right. So that's really positive. Okay. So that's the United States stock market. Okay. Look at European stocks. This is another trade that I'm in with the members. We're buying the European stock market. The European stock market is rallying a lot stronger than the United States. At the beginning of 2022, look, since the beginning of the year, stock markets in Europe are up 10%. If we compare that to the United States, from the beginning of the year, stock markets are up 8%. So the European stock market is pushing up higher. Why is this happening? It's happening because Europe is no longer expected to experience a recession. Some economists are saying they're going to avoid a recession. And because markets had been pricing in a recession in Europe, and remember, a recession just basically means the earnings of companies are going lower, because GDP, the value of the European economy, is just all the earnings of companies added up. to get the total value of an economy. And now that investors are predicting that the earnings of companies won't be as negative, they're getting into European equities now. Why are they getting into European equities? Because natural gas prices are falling. And remember, the natural gas prices was the reason why there was such high inflation. Look how much natural gas prices are falling because of warmer weather. China's reopening is very important. Germany is the biggest economy in Europe. What's happening in Germany right now? Their biggest export partner, China, is reopening. That means more goods are going to be bought from Germany to China. It helps Germany's economy recover. Germany is the economic powerhouse of Europe. What does that do for the European Union? It's positive. That's why European stocks are going up. Falling energy prices, falling, a reopening of the China economy, and the change in the tone of the market's expectations for Europe avoiding a recession is good for Europe. That's positive, okay? So I'm buying European equities. That's a good trade. Stop loss on that position. If you're going to hold that trade, let me get that for you now. This is volatility on equities. It is around 8.34%, 1 month volatility. So your stop loss, if you're jumping into trades, needs to at least be 8% to make sure you don't get stopped out from a fluctuation in price. All right. And then on top of that, the euro. Why does the euro keep rallying against the dollar? Why do investment banks like Morgan Stanley see the dollar going up to 115 against the euro? And this is actually the same level that Goldman Sachs was talking about today on Bloomberg TV. They're saying 115 against the euro. Why? Because the European Central Bank is saying, because core inflation in Europe is still rising. So I'm going to show you over here. So look at the difference between the United States and Europe. This is what's driving Euro USD. Core inflation in the US is coming down, as I just showed you guys. Look, core inflation going down for 3 months in a row. Coming into 2023, we've had core inflation dropping 4 months in a row. But look at Europe. It's not the same situation, okay? If you look at Europe, core inflation is going up 4%, 4.3, 4.8, 5%. And the latest reading came out in Europe at 5.2%. So core inflation keeps going up. And because core inflation is telling you that prices in the economy, if you strip out energy prices, food prices, you can't really control them prices. That's set on an international market. This is why the European Central Bank is saying there's 2 more half-point increases coming by around May. And if core inflation doesn't come down, they'll keep raising interest rates. As you guys know, interest rates drive the currency markets. So the euro against the dollar last year was being driven by the US raising rates at a faster pace than Europe. But now the tide is turning where Europe is raising rates this year expected at a faster pace than the United States. Here you have the interest rate differential between Europe and the US. And here you have the exchange rate. And look, they literally follow each other. Because if you look at the difference, anything in negative territory is basically telling you the US pays a higher interest rate than Europe. So what do European investors do? Put their money in the United States because they get paid higher interest, right? And that's what caused the currency pair to go down. And look, you can even see when the US interest rate starts to go from 2% to maybe 1.6%, for an example. Look, you can see that difference in the blue line. Look what happened to the euro. It rallies against the US dollar. And as soon as it goes back in the dollar's favor, the dollar rallies against the euro. So the interest rate differential really plays an important part in currencies. And that's exactly what we're seeing right now in Europe and the United States for the whole of 2022. But now that the market is expecting the European Central Bank to raise rates faster, now we've got a change in trend. So don't be expecting the dollar to strengthen against the euro unless the Fed starts raising rates beyond the market's expectation, because inflation doesn't come down quick enough. Then maybe we get a change where the dollar could strengthen again. But as long as the European Central Bank's raising rates and markets are expecting the Fed to cut rates, you've got a policy divergence that supports the euro. And if you're looking at volatility in Euro USD, that is around 4.3%. So we're looking at this is the stop loss has to be around here. That's 1 month volatility. All right. I'm in this trade already. So that's Europe. Okay. We looked at European stock markets. We've looked at the euro against the dollar. And if you look at other trades, look at USD JPY. Why is the dollar getting weaker against the yen? Exactly what I explained. interest rate cuts in the United States. The only reason the dollar was getting stronger against the yen all of last year, all of 2021 and 22, higher interest rates in the US, lower interest rates in Japan. But now markets are pricing rate cuts. Look at the trend. It's now going against the dollar. And that will continue if US inflation keeps falling and Japanese inflation remains high, because markets are betting that the Bank of Japan, which is the only central bank to keep rates at zero, will have to change their tone. So that's why on Telegram, I posted this yesterday for you guys to get a good understanding on this. When I posted this video on the Japanese economy, and I gave you a really good breakdown for why Japan may raise interest rates. What would be the key catalyst for the Bank of Japan? All right, so that's important to understand. So look, you can look at the differential in interest rates between Japan and the United States. Clearly, the two move in extremely tight correlation. All right. So this again is important to understand. Look, as US interest rates are going up higher than Japan, the currency pair strengthens. As US interest rates fall relative to Japan, the dollar gets weaker against the yen. As it rises, okay, you can see that really, really strong correlation between the two. All right, so really important to pay attention to this data. I think I had the 2-year bond yields. Let me get up the 10-year. It gives you a better reading. Sorry, I think I picked up the wrong spreadsheet. Let me take you over here. Here we go. Okay, here's a clearer reading. Look at USD JPY. Here you go. Look, in 2020 up until 2022, look at the difference in interest rates in the blue line. The US interest rate advantage over Japan went from 0.5% to 4%. Look at that massive interest rate difference, okay? And that's what dragged up USD JPY. And look, soon as it started to turn against the dollar, you've already seen the trend turn against the dollar already. So we can sell USD JPY on falling inflation and market pricing in interest rate cuts. That's really important to understand. Then we've got the Aussie dollar. This is another really good trade. Okay, if you're looking at the Aussie dollar against the US dollar, the Aussie dollar is getting stronger against the dollar. And this is because if we're looking at the Australian economy, what does Australia sell to the rest of the world? Iron ore. That's their key commodity. Who are they selling iron ore to? China. What's happening with China? They're reopening their economy. This is what drives Aussie dollar, US dollar. And if you don't believe me, I'll show you something over here, which will just give you a perfect pictorial display of this correlation. Here is iron ore prices in red and the Aussie dollar against the US dollar. Look, the two move in perfect correlation. If iron ore prices are going up, the Aussie dollar strengthens. If iron ore prices are going down, the Aussie dollar weakens, okay? And at the moment, we can see that the iron ore prices are on the rise because of China's reopening. Look, no surprise. Look at the left-hand side. Can you see when iron ore started to rise on the 31st of October? What happened to the Aussie dollar, US dollar on the left-hand side? Look, going up at exactly the same time. So if iron ore prices keep climbing, we keep buying Aussie dollar, US dollar, which is a trade I'm probably going to get into quite shortly. All right, so this is just a short overview, guys, to understand the fundamentals driving prices. These are the kind of trades that I'm getting into with the members. It's all fundamental, all fundamental. We're not looking at technicals and none of that nonsense until we understand what's really driving markets. And if you want to come and join the trading team to take these trades, remember, you get a 30-day free trial. You don't have to pay. You can come and try it for 30 days. All you got to do is fund your own trading account and you could trade alongside us. We've got community group chats. We've got membership support teams, teach you how to open and close trades. Really simple. So if you're interested, guys, just drop us a message. You're more than welcome to come on board. And again, if you want to learn more about trading for yourself, become an independent trader, we've got online courses there as well for you guys. All right. So I hope you guys enjoyed. If you've got any questions, I don't mind doing a quick Q&A. So please fire away your questions and I'll cover anything you may not understand. Bitcoin is going up right now because stock markets are going up. If you understand crypto markets, crypto and stocks move at exactly the same time because it's now seen as a risk asset. Okay. But remember, you've had this collapse of FTX, which was a big problem. But look, US stock markets on the right-hand side. Let me just change that. US stock markets on the right-hand side, look, going up. Look at Bitcoin at exactly the same time going up. Bitcoin and Ethereum, they move with stocks. Look, exactly the same time. So all we got to do, if you want to trade crypto, you just got to trade the stock market. You got to know where the stock markets are going. That's based on economic data. Again, fundamentals driving markets. Key to trading. All right. So that's the cryptos. Yeah, the pound, I wouldn't touch the pound. I was actually in a buy position for the pound, but I've closed it because the markets are now pricing in interest rate cut by the Bank of England this year because of a slowing US economy. I think I posted something like this for the members earlier this week. I think I posted something on this. Where did I post something on this? But yeah, the pound basically, I wouldn't, well, personally, I'm not trading the pound because markets are betting on rate cuts. So if they're betting on rate cuts by the Bank of England at the same time as betting on rate cuts by the Federal Reserve, the pound has no advantage over the dollar. So yeah. All right, guys. So hope you enjoyed that. Again, if you're interested in training, get in touch with me. But I hope you have a lovely weekend, and I'll see you guys soon.